Hello, Baker Investment and Portfolio students. So, hope everyone had a good weekend. I made a little road trip to my relatives in Wisconsin, so just got back. So, just getting ready to post this for our coming week. So, hope everybody is doing well. Stock markets, as we kind of saw last week, still a little rough. As many of you noted in your portfolios, just looking at mine, I'm still at a $34,000 loss, even after getting a dividend. And my portfolio beta is just 0.60, so in that sense, it's less volatile than the S&P 500. Again, that idea with beta being that the market being the independent variable and your stocks change being the dependent variable. So, but this week we get a little bit more detail about analyzing common stocks. Start to look at valuation models, look at financial ratios. So, in addition to your readings in chapter 7 and 8, continue to plug along with your weekly portfolio discussion, work on your homework, and don't forget, to spend some time. We're a little bit slower in these weeks. You just have the forum discussion and the homework to start looking to those papers because they're going to come up very quickly because these courses move so fast. So if you do have any questions, reach out to me. But otherwise, I just want to give you a few insights for this week. First was just chapter 7. The approach for the authors was that you have to look at the economy first, then you look at that industry, and then you look at the company specific, the management, the future potential earnings of your companies. And many of you, have been doing research on your companies or learning new things about your companies through your forum posts, which is good, is what I want you to do, is discover things about them. What makes them tick? How does the management work? Where are they having successes? Where are they having challenges? So a lot, as I mentioned, I think in one of my talking to my relatives, just the supply chain issues and some of the responses back in your forum post this week. My wife was just telling me something about paint that's going to be hard to get if you're thinking about repainting your home. So these have definitely been challenges because especially if sometimes it's an input good or if you need chips to make new cars. It surprises me how much used car prices are now because just that there's such a high demand for cars and not able to produce them that we normally have. So with that, one thing I'll also point out, Baker has some great resources there, but subject guides for industry. So if you're interested in looking at that stuff, kind of look at trends, what's happening in those industries, about the competition in that industry. Mine, I obviously chose all energy for my stock. I would, not recommend doing that for a total portfolio, but I was just interested in tracking some energies over this 6 weeks. So, but you're going to look at a lot of fundamental analysis, and that's what we want you to do when you're looking at stocks. Is you're doing the math, you're projecting out, you're being rational about why you would purchase this stock price. You should only be willing to buy something based on some expected return that you're going to get in the future. Of course, nothing's guaranteed about companies in the future, but you're being rational about whatever information is available, whatever your calculations you're making based on that cap in or opportunity cost, that it's or meeting that required rate of return. And, I'm willing to pay $50 for this stock, but if it's trading at $60, you shouldn't be buying it. So I remember some things with this craziness of this trading recently with AMC and I think GameStop and the other things. There was no rational reasons why these stocks would be priced this high, but I think it was just that ability for people to go in and just buy it for just very small dollar amounts, maybe to punish someone, was driving up the price to irrational levels. I think it was to punish some, maybe it was a hedge fund or something like that, so if it's moving the opposite direction. So maybe it's almost like people are willing to throw away a few dollars in order to make a statement. So, but with this, you're going to be looking at financial ratios, the liquidity, how quickly can we convert or pay things that bills come due. You're going to look at the activity ratios, turnover ratios, inventory, total asset, leverage ratios. What is our debt to equity? I like to think of it as the spoons and the cups, the spoons being the stocks and the cups being the bonds. But you can definitely magnify certain things like earnings per share by the use of less stock and more debt, and companies do get to, for tax purposes, write off interest on any debt that they have. but the more you're leveraged too, that you still have to pay back that debt too. So it can also be a risk. Profitability ratios and common stock ratios might be, I mentioned earnings per share, PE, dividend payout. So with that, again, just the thing, it's good to maybe like understand the company, but because things adjust so quickly in markets, I would argue that it's good to understand, if you're an analyst analyzing the companies, you do need to understand these ratios and understand how these ratios compare to firms in the industry, and also how has this company done with these ratios historically. So are they improving? Are they getting worse? So I'd say those things are more important because it's very hard to predict, the future again and what's going to happen. So, but if the company is managed well, you would hope that these ratios would be in a positive light. Chapter 8, you're going to spend a lot more on looking at a little bit of theory, the Gordon Growth dividend model. We probably you've seen this before, maybe from finance, where it has the dividends of 1 in the numerator, and then you have R minus G in the denominator. Expected that these dividends are going to grow at a certain rate. Like to give you an example, I own Evergy Energy stock in my IRA. They've slowly increased the dividend each year. So that's a growth rate that you can measure. But if the required rate of return for the investor is, let's say, 10% or 8% on Evergy stock, and if the dividend is growing at 4% rate a year, let's make it more 3%, then I could take 0.08 divided by, or 0.08 minus 0.03, give me 0.05. If the stock dividend is $2 a year, I take that $2 dividend divided by that number in the denominator, and that should tell me that, based on just this simple theory, is approximately what you should be paying for the stock based on this expected return. But there's a lot of assumptions in this model that dividends are going to continue to grow into the future, and there's no guarantee in that. And most managers and companies don't like to pay a lot in dividends, or they don't want to pay out something that they can't promise in the future. They don't want to reverse course on that. That happened to GE a couple of years ago, but like a historical company just kind of went kablooey, it blew up, and had to stop paying or lowering the payment of the dividend. So, but you're also going to look a lot more at forecasting models, that projected cash. The idea that this can, as long as the company, is entity, can go on going forever in theory, and continue to pay some residual value into the future. I can discount that all back with some required rate of return, again looking at those cash flows. So, and you're also going to look at some other items too, just simply interpreting with some of those things. What they talk about this a little bit more. If I see these other approaches, they look at relative price, other price relative procedures, earnings per share times PE ratio. Question whether this stock is overvalued or undervalued based on these PE ratios. So there's a multiple amount of ways that you could analyze, whether the stock is overvalued or undervalued. That's what analysts are doing all the time for the mutual fund companies, or those the reporting agencies, or the ones that say buy, sell, or hold. They're trying to give advice to investors to say, based on all the math that I've done, this would be a good investment, or this would not be such a good investment, or we don't necessarily want to put this in our portfolio for managing a fund. But if you're buying the S&P 500, you're going to, if you manage that type of fund, you're going to buy that whatever stocks in the S&P 500. So it's not much of a thinking man's game. It's just simply you're just buying those stocks. But the hopes would be that you're purchasing stocks that you think are going to add value, either in future price accumulation, or they're going to be able to pay out dividends. Young companies usually wait to pay out the dividends, but more mature companies will pay out dividends in the future if they're doing well. So, well, that's it for this week. So if you do have any questions, do email me. But otherwise, look forward to your forum post later in the week. I'll jump in there again, but have a great week. And hopefully the markets do a little bit better this week. We'll see what happens. Take care.